Okay, this is the video upload for the appendix to Class 1. We didn't have a chance in our class on Tuesday to go through the appendix materials, and I trust you can go through those on your own, but I thought it might help to upload this video and walk you through it. In future classes, one of the things that we'll often do is there will be an appendix at the end of the prior class's deck that I'll leave with you to do as part of your homework assignment. And in the subsequent class, we might spend some time going through that appendix and making sure that we're all on the same page in terms of what the content was all about. So for class 1, like I was saying, we're not going to spend any time in class 2 going through these materials. So I thought we would use the video upload technology to cover that content together. There's in the appendix to class 1, there's one example, and which I think covers probably 4 or 5 slides, and then there is one problem, and we'll go through both of those together. Okay, this is the example. The purpose of the example is to talk you through a basic provision hypothetical and confirm our understanding of permanent and temporary differences. Okay? So through this example, I just need to get my pen out here. Sorry, give me 1 second. Okay, so through this example, we're going to learn about permanent and temporary differences. So the example would say that there's book income of $500,000. Okay, that's our pre-tax income, and our tax rate is 35%. What they list in the table that's underneath those words about book income and the tax rate is these are our book versus tax differences here. Okay? And we have 4 questions. We'll come back to these book tax differences in a second. We have 4 questions that we're trying to answer. One is, what is the impact, essentially, on account of permanent differences? What is the journal entry that we would book for permanent differences? Third, what is the journal entry we would book for temporary differences? And finally, what is our total income tax expense? Okay? So that's the problem setup. Next slide. Question number 1. Recall that the question was, what are the permanent differences and what are their impacts? Okay. So of those 6 differences on the prior slide, 4 of them are permanent. Okay. The first one, tax-exempt income. So we said tax-exempt income, that's within our $500,000 of book income, there is interest income that will be never taxed. You will have a permanent reduction in your tax liability on account of the fact that that tax-exempt interest is never taxed by a taxing authority. Okay, permanent difference. The other 3 items are similar, although as you can see by the direction of the number over in this section, that the other 3 items are actually add-backs and permanently increase our tax liability. So penalties, fines, non-deductible meals and entertainment expenses, all of those types of expenses are non-deductible. They're permanently non-deductible, and they increase the amount of tax liability that the company has by $4,725. Okay. Okay, question 2. Let's come up with a journal entry. Let's talk about the tax impact of our permanent items and reduce those to a journal entry. Okay. The first thing that we address, there's 2 journal entries here in the solution. The first thing we address is the effect of book income. Okay, book income. And remember, step 1, step 2, step 3. We talked about this a lot in the first class, and you're going to keep hearing about it. Step 1 is our current payable. So if you were just thinking about book income and what the impact to the payable would be, well, you would set up a liability for $175,000. That would be step 1. Right? You would calculate your payable with respect to book income. There is no step 2 because we have no deferred taxes at this point in the example. And so step 3, which is balancing our entry, would be booking this entry to expense as a balancing entry. Okay? So we're going to credit our payable for $500,000 times the tax rate and offset that with an expense entry. The second entry that we'll book will be the tax effect of the permanent differences, and we're going to follow the same three-step process for understanding the effect of this 4725 in terms of its impact to a journal entry. So our step 1 entry will be to increase our current payable, because as an aggregate amount, these permanent differences are going to increase our tax liability. Still, at this point in the example, we have no temporary differences and therefore no deferred, so there is no step 2. And again, the same as the above entry, we have our step 3 balancing entry as an increase to an expense. Okay? So we have one entry to book the effect of our book income, and a second entry to book the tax effect of the permanent differences. Question number 3 dealt with temporary differences. And of our 6 book tax differences that were shown on the prior slide that was setting up the problem, 2 of those differences are timing items, or temporary differences. And those differences are warranty reserves and depreciation. Okay. So we talked about warranty in the first class, and with respect to warranty, you will get a future tax deduction. This is a future deduction because warranty expenses are deductible when paid. And with respect to depreciation, I'm just going to flip back to the setup in the problem. Oops. With respect to depreciation, the facts were that in year 1, which is basically the year that we're starting with, we have an excess of tax depreciation over book depreciation. Okay? So what that means is this year we're going to take higher tax depreciation than book, but in the future we'll have the opposite. Book depreciation will be bigger than tax depreciation because over time the book and tax depreciation will be the same. It won't be the same in any one year, but cumulatively it will be. Okay? So forwarding back to our temporary difference slide, we said that warranty reserves were a future deduction. Well, with respect to depreciation, it's going to be the opposite. Okay? There's going to be future tax. And the reason is, again, we claimed excess tax depreciation in year 1, which means in the future we'll have the opposite. We'll have less tax depreciation than books, which on a relative basis will mean that we have more taxable income. Okay? Another way to look at this is we talked in class about our book and tax basis in an asset. And let's say that we started with the same basis. Let's say we started with 50 and books depreciated 10, so there is a basis for books of 40, and tax depreciated 9 more than books, so that would be 19. That would mean that the tax basis is 31. So that difference in the basis of those assets, that difference will be realized at some point in the future. And remember, the hypothetical that I asked you to think about is what would happen if you sold your asset for book value in cash. So if you sold this asset for $40 in cash, or $40,000 in cash, you would have a $9,000 tax gain because of the tax basis being only 31. And ultimately, that is what explains our cumulative temporary difference of 9,000. Okay? So in aggregate, we have a net temporary difference which is going to give rise to taxable income. And again, after applying the tax rate, the theory would be that when those two temporary differences flip or reverse, there will be a tax liability of $2,100 that's incremental to what you'd otherwise have from book income. Okay, so let's reduce that to a journal entry. If we follow the step 1, step 2, step 3 format, it's going to be showing, it's going to show up a little differently than is presented here in the solution. So I'm going to use the step 1, 2, 3 theory and walk you through that. So step 1, in the current year, we've actually saved ourselves $2,100 in tax on account of these temporary differences, meaning the fact that we deducted this excess tax depreciation, even though it was offset partially by the add back for warranty reserves, it saved us $2,100. Okay? However, in the future, so that's step one, we're going to book the adjustment to our payable. In step two, we're going to book the effect of our deferreds. And you can see I wrote step two kind of between two numbers, because when you look at the deferreds in total, it is a net credit to the balance sheet of $2,100. And that's exactly what that number is representing. Okay? So step one, debit liability for $2,100, and step two, credit deferred taxes for $2,100. There is no step three because we already have a balanced entry. Okay? So the one thing that I will point out is that the solution journal entry does break out a gross deferred tax expense and a current expense. And this will mean a lot more in later classes when we get into the gross components of income tax expense. But for now, keep in mind that those two numbers offset to zero. And all that those will be doing on a gross basis is signaling to a reader who reads our financial statements that we are saving money currently, and that's what this current tax expense reflects. And in the future, we're anticipating that we will have a tax liability and thus have a deferred tax expense currently. Okay? But if you're thinking step 1, 2, and 3, this is a balance sheet only entry. Okay? All right, the fourth question was summarize the total tax expense. Okay? And you probably remember from the first class that the total tax expense is really made up of the tax that you're going to pay today plus the tax that you'll pay or save in the future. Okay? And what this table basically summarizes is all of the components of our income tax expense. And I want to draw your attention specifically to this middle section, because I think one of the aha moments from the first class is that the components of income and book tax differences that drive the provision are really limited to your book income and your permanent differences. So you can see that just by virtue of factoring in your book income and permanent differences and applying the tax rate, we get our expense, right? And the impact of the temporary differences, which I said in the prior slide, net to zero, and they show that being here the case too, those temporary differences really do not impact the total tax expense. Okay? So you could explain the provision expense with reference really just to book income and perms, and know that the temporary items move the balance sheet up and down. Okay? So that's the first example in the appendix. Now on to the problem. So the purpose of the problem is to help you get a better handle on book versus tax basis differences. And I'll give you a format that you can think about to do this exercise. You'll see in the facts section here that we've got some pretty typical temporary items. We have some reserves. We've got some bad debt reserves, inventory reserves, severance, warranty, and then this is really all the same thing, being depreciation. Okay? So don't worry about following the details of the facts too closely. It's not that important at this point. Okay, so the format I want you to think about is, think of a balance sheet where you can look at the balance sheet line by line and understand what is the book basis of my individual assets. Okay? And you ought to be able to gather this information from a simple trial balance. But we want to know, what is the book basis in cash? What is the book basis in receivables, inventory, fixed assets, etc.? We want to know what the book basis is. And then ultimately, we're going to compare it to this tax basis. And just like in my example a few minutes ago with the depreciation, we're going to take book basis, compare it to tax basis, and then out of that will come our temporary difference. And again, the theory would be if I sold my assets or settled up on my liabilities for an amount of cash that equals book value, then I can identify essentially in this column what the tax consequences of that hypothetical would be. And those tax consequences will mirror what the temporary either deductible or taxable differences will be. Okay. This slide is really the same information. It's just the liability section of the balance sheet. Okay. Same format, and the problem is just populating the book basis information. Okay. So we have assets and then liabilities. So this page is the solution, and oftentimes when we have a problem, we'll follow it up with a solution, and you can tell very clearly up in this upper right hand corner that there'll be a box called solution, and that's your signal that we're going to go through the answer. So in this appendix I've included the solution for you. Oftentimes what I'll do is I'll put in the appendix the problem, and then in the following week's materials I'll pass out the solution to the appendix. And mostly that's because I want you to struggle through it a bit on your own. And it's a much better learning experience if you try to figure it out versus you just look at the answer on the page. But for this first class in the appendix, I just want to show you how I would go about coming up with the temporary differences. So let's take receivables for starters. For book purposes, the company sold a product and expects to receive $13,000 of money from a customer. That's its accounts receivable. What they subsequently did was said, well, not everyone pays, and so we're going to estimate that 2,000 of our 13,000 of receivables will go bad. So our book basis and our receivables net is $11,000. Okay? By contrast, for tax purposes, you recognize the same 13,000 of revenue. You fully expect to get paid 13,000, and there is no tax concept generally for bad debt reserve, taking a deduction for an estimated reserve. And so your tax basis remains at $13,000, which means that if you were able to sell your receivables to some third party for cash equal to $11,000, you would actually suffer a $2,000 loss. And that $2,000 loss reflects the excess of our tax basis, right, over our book basis. Okay? And that portends a future tax deduction, and that's a benefit, right? Relative to the book value of assets, our tax basis is higher, and so we have a future deduction coming. Depreciation is, at least in this example, was exactly the opposite. You can see that for book purposes, there is basis in our fixed assets of $24,000, and for tax purposes, the assumption is these things are fully depreciated. So if I sold my fixed assets for $24,000, which is book value, I would actually have a $24,000 gain. And that gain will give rise to future tax, or a future taxable income anyways, that once applied to the tax rate will result in tax. Okay, so what I want you to be thinking, the reason I'm showing you this is I want you to be thinking, what's my book basis? Subsequently, what is my tax basis? And if I compare those two, in the future, will I have a future deduction or future taxable income that's incremental to my book income? You will do the same thing with respect to the liability side of the balance sheet. And like I said, yeah, it works exactly the same. So let's take warranty, for example, since we were focusing on that on the class 1. So for book purposes, they have a liability of $6,000. They've expensed it. They show it as an obligation due. For tax purposes, that's not a liability that counts, if you will, for lack of a better word, until for tax purposes you pay it, and then you're able to claim a deduction. So once you pay it, you get a future deduction. And I think the concept of tax basis and a liability is a little tricky. But I would think of it as until the expense has run through the tax return, something that creates a deduction for that liability, you essentially have no tax basis. And so this would, 6,000 over here, that would be a future tax deduction. Okay? So you ought to be able to do that with every line on your balance sheet. Sometimes you'll end up with zero difference. You'll say, look, I use the same method for book that I do for tax, and there's no difference, and it's as simple as that. But from a process perspective, I want you to think about starting with book, comparing to tax, and coming up with what your basis differences are. Okay? That's the way to be thinking through that. From as far as the impact of temporary differences go, we had gone through examples in Class 1 that basically would illustrate that there are no differences to the expense as a result of timing items, because all that happens, just like I illustrated back here, all that happens is you have movement in the balance sheet, right? I'm just going to reinforce this point. When you have temporary differences, all that happens is you have movement in the payable and movement in the deferreds, but you don't have a change to the total tax expense. Okay? So I think I'll leave you with these two columns, Provision 1, Provision 2, and why don't you just follow these through from top to bottom and understand the debits and credits. And if it helps you, get out a piece of paper and go through Step 1, Step 2, Step 3 for each of the rows in the example. Make sure that you can come up with a balanced journal entry that gets to this total tax expense. And that you understand the effect of putting temporary differences into the equation. Okay? So that's it for now. That's the walkthrough of the appendix to Class 1. Hope that was helpful, and I'll see you in Class 2.